Hi, everybody. It's Tuesday, September 16th, 2025. Our episode starts with our headline: The market is Schrödinger's cat. Fed guidance opens the box. We already know that there's a 25 basis point cut coming tomorrow. Fed funds betting a 4% chance of even a double cut, a 50 basis point cut. But it's more really about the forward guidance. How many more cuts are we going to be expecting going into the future? And also, how are markets going to interpret that data? After all, we have gold rising and the dollar falling, suggesting, hey, what if we get inflation worse here? But then we have the 10-year break-even inflation rate not showing any stress, not yet. What will the reaction be? What will gold do? What will the dollar do? What will the 10-year break-even inflation rate do? What will the most expensive stock market in all history do? What will extreme high risk assets like all the cryptocurrencies in total too minus Bitcoin, what will they do? And then on top of it all, you have the the 10-year Treasury note yield, which is really sort of the center of the whole financial universe as far as I can tell. This one seems on the verge of breaking down, which means that the Fed is going to be more hawkish than what the market thinks is actually appropriate. But all these markets are saying very different things. We have high risk markets saying risk on, risk on. You have the 10-year Treasury note yield saying watch the heck out. You have gold and the dollar saying watch out for inflation. And the 10-year break-even inflation rate, not really too worried yet. I'd like to suggest that the Fed has no idea what's going to happen, and that's why I'm calling market is Schrödinger's cat. What's going to happen off of this Fed guidance moving forward? FOMC meetings that cut or raise the federal funds rate are a big part of history. We're going to see it on the Fed chart for the rest of time, what the Fed decided to do in this environment and the reaction of markets and the economy. Personally, I agree with the 10-year Treasury note yield, and my crystal ball reading still remains the Fed won't cut fast enough to save the economy. There are details in the charts we'll go over momentarily. Before that, community topics. What moves, if any, did you make today? I can't help myself. I'm buying more HYG puts. When the stock market goes down, credit spreads blow out. And the beautiful thing about having longer dated HYG puts is that HYG can only go so high. Not like the stock market getting puts on SPY. Well, what if SPY goes up another 30% before it drops, 50%? Puts on credit spreads, they can only get so tight before they're matching the Treasury rates. So, and currently under 3%, already being historically tight, still one of my favorite places to be, especially right now in the cycle. Again, we have charts to talk about today. Coming up tomorrow, obviously, the FOMC meeting. We have Thursday, weekly jobless. And the one that sticks out to me for this week is the initial claims. Remember, we just hit a new high, multi-year high in the initial claims. If this continues higher and higher, that 25 basis expected point cut is going to start to look a little too weak, especially considering how when the Fed funds changes their target rate, it takes typically a long time for that to really actually find its way into the economy. This isn't one of those things where you turn on the switch and the light goes on. It's often referenced that it takes 9 months or even longer for cuts to actually have any positive effect on a slowing economy. So look out for that initial jobless claims report. We also have leading economic index, like I mentioned in yesterday's show. The last reading of this showed the previous 6-month period to 2 6-month periods ago to the previous 6-month period, an acceleration to the downside. This is a humongous warning sign along with everything on my website. And of course, tariff updates. Thank you for watching, liking, subscribing, commenting, and supporting. see the link in the description below to see my overall daily reminders, current macro reviews, and portfolio explained on my website. All right, on to the chart, starting with SPX, the S&P 500, dropping a little bit today. And just as a quick note, this pretty powerful orange trend line that we have, that we seem to have broken out of yesterday, we didn't get a confirmation candle. Pros like to see a close above the full candle of the breakout candle in order to actually get bullish here. So this actually, believe it or not, could be the top for a very long time. Admittedly, I think I called the top back here in August, around there, and I was wrong about that, and maybe I'll be wrong again. But just as a little reminder, it's also on my website, taking a look at the S&P 500 dividend yield. How much is the S&P 500 paying the investors that are owning it? 1.16% of the value. So if you own $100 of SPY, you're basically getting $1.16 when, back in 1800, you'd be getting $4. You wouldn't be getting $1.16 a year. Sometimes you'd be getting $9 for the year. Briefly, in the Depression, when you were really supposed to be buying stocks hand over fist, it was paying out over $13 for $100 of stock. I think it's ignorant to think that that could never ever happen again. Just for the other part of this, the lowest that this ever got up through the 70s was $2.67, and then we head closer. Let's zoom in here. Let's do a 50-year chart. We get to 2000, we get an all-time low of it paying only $1.11 for $100 invested in the S&P 500, and then great financial crisis hit. We peaked at $3.60. And what about today? Well, we've never been this low since the dot-com era. This scares the heck out of me, at least for investors that are holding the S&P 500. And the contents that are driving this price to be so enormously high. Again, please go through my website. This is a good time, better time than ever to be highly aware of how overvalued stocks currently are right now. I do not believe it's a waste of your time. Also, please never take anything, my website or anything on this show, as any kind of investment advice. This is education, entertainment only. U.S. 10-year Treasury note yield still knocking on that 4% level. To me, it's almost like it's saying, okay, I want to go lower. I'm trying to go lower, but I'm not going to go lower until I know the Fed is not being too dovish here. And ironically, the 10-year note Treasury yield drops when the Fed is not expected to be cutting aggressively enough. Will tomorrow mark the end of this unbelievable inversion and flatlining of the 10-year minus 3-month Treasury? It's practically poetic on a day like today, before the first cut of what we expect to be a cutting cycle, to be at exactly 0. You can't get more indecisive than that. With all of this data and background stuff going on showing such craziness, it is just so absolutely amazing to see the S&P 500 sitting at an all-time high basically right now, along with the VIX being far below 20, picking up a little bit, but not showing any fear. Apparently, nobody thinks that the stock market's going to crash. Or there's such a low probability of it that, that the sellers of options contracts are willing to take that risk of not asking for a higher premium. Even the VVIX volatility still officially in the normal range, although rising into, looking like it may pop into the rising uncertainty zone soon. But hey, I have been expecting a market correction, a sustained market correction for a while now that it hasn't occurred. Even Michael Burry, I think it was like, what was it, 2 years ago now that he put it on Twitter, sell. And that was the only word, apparently. And it was apparently a time to buy. But, you know, you got to kill all the bears before we can get bearish. And another way to look at options is the SKU index. The SKU index represents the pricing of far out of the money contracts. So basically, when people are loading up on puts that are just like, they're not going to make you any money unless literally the stock market crashes. You know, it's funny. We find peaks in this, like in 1998, and then lower peaks going into the dot-com bust. Similarly, you know, we had a peak in the SKU index all the way back in towards the beginning of 2006 before going lower, then going into the great financial crisis. And what do we have today? Sort of a similar thing. We had an all-time peak actually beginning of 2025, now finding lower highs. So, you know, the bears were loaded up on like far out of the money puts in January, which, you know, ended up paying out to some degree in April, you know, briefly. But now, you know, nobody wants those puts anymore. Not as much anyway as that time period. All while we're headed into the first cut that's expected to see cut every month. And since 2000, again, guys, when you go cut, it goes straight into the gray bar recession. .com bust. Great financial crisis. Cut. Recession. Before COVID, believe it or not, July of 2019. Cut. You know, a brief recession before we turned the infinity money printer on and the stock market went to the moon. And here we are at all-time highs while the Fed is cutting it. It's going to be falling month over month starting tomorrow. And the market doesn't seem prepared for it. But I guess that's just how it's always going to be. Now, while it looks like we may have a top in the highly overvalued S&P 500, for many reasons, I think this is going to be the top. You know, undervalued stocks in emerging markets seem a bit more bullish. KWEB, my favorite Chinese internet ETF, connect January 2023 high to the October 2024 high. We broke above it and we confirmed today. This is looking hecka bullish and deserves to be bullish since the valuation of these companies is so far behind all of its American counterparts. So if we get rotation into that and maybe into Brazil, my other favorite emerging market ETF, EWZ, perhaps these runs can continue actually to the upside as investors struggle to figure out what to do while the S&P 500 inevitably drops. And don't forget that drop in April. Oh, wait, that's not April. That was February of 2007. But when people were starting to flip out over things getting bad. And what happened? Oh, we got to all-time highs. And what happened after that? Oh, my goodness. It looks like we were about to fall off the face of the planet. And then we went even higher after this major dip in August of 2007. And then we got to our ultimate peak October 2007 before the real fall began and did not end for years. The stock market going down for years. But don't worry, guys. It's different this time because of AI or something like that, right? Again, please never take anything I say on this show as advice, especially if I happen to be right about something. I can be wrong about something the next day. Be careful with your money. Do your own homework. Do your own research. And understand that there is always an element of guesswork involved in all of this. And that's all from me and my crystal ball. I hope you enjoyed. Thank you for watching and see you next time. Robschild.